So this video is for the financial units of business studies, and it's looking at return on capital employed. Now, the ROCE is a really important financial indicator for performance, especially to investors. If an investor is considering whether to invest into a company or not, they'll often look at the ROCE as one of the most important factors. And the reason for that is because obviously when we consider capital employed, the majority of that capital employed might be share capital. And they need to make sure that they're actually getting a return on that investment. Now, the return will come in the form of obviously operating profit. So what they hope for is that the business will become as profitable as possible to really make it worthwhile to get that, obviously, that return for that initial investment. Now, how they calculate it is by the operating profit divided by the capital that is employed into the company times by 100 to get a percentage. Now, in terms of this formula, it might not be straightforward because you might have to calculate both of them. Now, you should be able to know how to calculate operating profit. You've been doing that throughout A-level and in GCSE as well. But capital employed, sometimes students get a little bit confused as to how to calculate that. Now, there's different ways of calculating capital employed, but you often get the information from your balance sheet. So if it doesn't give you the capital employed, there should be a balance sheet which will give you some key components as to how to calculate this formula. The first way you could do it is by getting your total assets, so calculating your current and your non-current assets, and then simply just deduct current liabilities from that. So you do your total assets minus your current liabilities. The second way you could do it is by getting your total equity and then adding it to your non-current liabilities. And both ways should give you your capital employed. And again, like I said before, once you've calculated both of those components, you divide your operating profit divided by your capital employed times by 100 to get a percentage. Now, in terms of knowing as to whether it's a good percentage or not, I've seen lots of interviews with hedge fund managers who said they will not consider any company below 15%. But it really depends. It's hard to say whether it's a good ROCE or not unless you're able to compare it. And in terms of comparing it, I've said this in other videos, often you compare it to previous years, and often you might compare it to the industry average or other rival companies. Obviously, the higher the ROCE is, the better it is for attracting investments. And it's also a very good indicator that the business is progressing. I also want to just bring your attention to this point. In general, investors tend to favour companies with stable and rising ROCE numbers over companies where ROCE is volatile and bounces around from year to year, because obviously you have to consider the risk involved as well. So we've got the data within this. This is part of a case study, and it's asking you to look at the return on capital employed for 1965 and 1975. Now, as I said before, it's given you some of the components, but not all. So it's given you, it has given you all. It's given you the net profit before interest and tax, which we just have to use, and it's also given us the total capital employed. Now, this case study is obviously nice. Not all case studies are as nice as this one, and sometimes you would have to calculate it. So in 1965, we've got 22 million divided by 121 million times by 100. It'll get us 18.18%. In 1975, we do 34 million divided by 203 million times by 100. It'll get us 16.75%. So you can see the highest ROCE was in 1965. Now, if I was looking at these dates and if I was an investor and I was thinking as to whether to invest or not, I mean, obviously there's a big 10-year gap between the two dates, but I would see that the ROCE has fallen. Now, in order to compare these two, it's quite difficult because of how big the gap is of 10 years. I'd like to know what it was, for example, in 1970. I'd like to have more data to be able to make a worthwhile judgment. It has fallen though, and it's not as high as it was in 1965. So you could say that an investor would probably rather invest in 1965 than they would in 1975, and it could suggest that the business was obviously even though it's got a lower net profit in 1965, if we compare it to the capital that's been employed, it's much lower than in 1975. So you could argue that with the additional capital that's been employed in 1975, it's not been very effective in generating that net profit.